Thanks everybody for joining.
Can you all see my screen?
We can.
Awesome. Trevor, please take it away.
Awesome. So welcome everybody. This is our Wednesday webinar, and we've rebranded ourselves a little bit. We'll talk a little bit more about that, but the Massive Realty Group. So we're going to talk a little bit about that, and we'll go through an agenda tonight, and there'll be plenty of time for Q&A. But at any time you have any questions, feel absolutely free to put them in the chat. If it makes sense to ask them immediately, answer them, we will, or we'll take them at the end and then we'll stop presenting and you can ask questions. We'll have an open format. And then once we're done, any questions for this meeting, we talk about anything. So a little introduction, Massive Capital, we're going to talk about our partnering opportunities. Then we're going to go into a case study, market strategy, and hopefully leave about 20 minutes at the end. For all of those that don't know John D. Rockefeller, the way to make money is by when there's blood running in the streets. And there's even a caveat to that, even if it's your own blood. So that's a bind. So this is an educational series. We are not financial advisors. We are not lawyers. We are not anything that has a title for it. This is for education. We try to present what we believe is the correct things to be able to do, but please, as always, make sure that you verify your own information ever before investing. This is our team. So on the left, we have our principals, Sanjay, Shirar, and Mike. They're the principals of Massive Capital. Across the top, we have our investor relations team. So there's myself, Jasmine, Maria, Candice. Then we have a Scott helping with marketing. On the center is more on our acquisition side. So we underwrite about, I think we're up to about 350 deals this year so far. And our acquisitions team there does all of the underwriting. We also have a junior asset manager and accountant. And then across the bottom, we have Angela, who is our chief of staff. Jonathan, who's actually hosting the meetup in Denver tonight, is our legal counsel. Senate is our director of education. And his wife, Carrie, is our event planner. So we are building out a pretty big team here. And the whole purpose of it is that Massive Capital does all of the work so that you can passively invest with a team that is well-rounded. So this is our sort of business plan, all the different things that we're involved in. So we do land banking, land packaging, land development, building development, building operations, building renovation, and property redevelopment. So we try to expand across all asset classes. And what this does is this helps you diversify your investments. So sometimes you don't want to be only in one asset class. You want to be in different types. You want to be writing different types of investment throughout the structure. So we are partnering up again. I don't know if you want to talk a little bit about it here, Shirar, or save it for later.
We'll save that for later as we get through the whole presentation.
So if you can see here, we've sort of rounded out a little bit more. So the realty partner ones, along with Massive Capital, and we're going to be partnering with somebody that gives us a little more leverage. So awesome. So this is Massive Capital, where we're at right now. So on the bottom left, and all the highlights of the cities that we're involved in. On the bottom left, you will see last year, we're about $140 million in assets. And all of those are listed here. Then so far this year, it's been a busy year. So we closed on a land development in Austin, 10 acres. We closed on Amberwood Apartments in Fort Worth. We're closing on a B-class property. So we can announce the name when we officially are done. We got like 2 more things to go in, but we're closed on that. We have a Class A retail development coming up in Austin, is the 506B, so we'll have to do that. And then we're doing a retail in Houston. We're waitlisted. So, we talked a lot about X-Space, and X-Space has turned out to be a great investment. So we have everything there, but so we've waitlisted for in case somebody commits and doesn't do it. And then we'll talk a little bit later, but we have our Denver project. Again, we talked about the meetup there. We're 65% subscribed, and we have till Friday of next week. And we think we'll be pretty close to full by the end of this week, middle of next week. So we're very excited, and there's a lot more coming. You can see the 10 deals last year, and we're already on 7 this year, and it's just the beginning of July. So watch out.
Thank you. And just to add the whole ticket about, right? You buy when everybody's scared, but not the way we bought it in last cycle, right? So this is awesome.
And so we do have the opportunity, so you can scan this particular one here. This is our value add in Denver. We do have an existing webinar, so if anybody wants a copy of the replay or any information of the slide deck, reach out to any of the massive capital partners. We are going to be doing another webinar on Monday night. I'm going to call that the last chance webinar, because we're going to be full. It's going to be great. It's very interesting to learn the differences between, I'm very familiar with the Texas market, and to learn the differences of a Denver market. And I always got to say, so this apartment complex was built same year I was born, and it's just as good looking as me, and it's good shape. So it's a really, really nice property. We're super excited about it. So hopefully Janae will get a chance to take a look at it while she's up there. So awesome. All right. And now we're going to go into youÂ're.
Oh, thank you.
Thank you.
So what we'll do is again walk you through a little bit more philosophy at and our approach to the market and how we are active here and what is driving us to be active. And before we do that, we'll do a little bit more of a case study. So case study we'll take an example of existing news and we'll dissect it out on the background, why it happened, and then our assumptions, and then how we are going against it or going for it, right? So on that note, as you guys know, I will start with the first asset class, the blood flow, right? Which is the asset class that is taking the biggest amount of bidding is the office. On the right side, I'm going to show this one. So if you can take a look at it, San Francisco office tower sold for 75% of the discount. It went to the market for $250 million, 250. Ended up selling a little over 60. I think it's $75 million. That's when I pulled the data. Went to the market for 250 and it was sold it for 75% discount. What's on the other side of it, right? Think about it. So blood is on the street. Why? For us, from the massive perspective, we saw that coming. Oops, sorry. We saw that coming right around the 2020. And that's also because, okay, sorry. Okay, so sorry about that. And then we also we thought it's gonna come in at what point in time since 2020. We didn't exact time, but we thought about 3 to 4 years out, and that's because most of the tenants they have long-term contracts. Like in the apartments, we have 12 months contract. For the office, you have 3, 5, 7, 10 years contract, right? So as the contract goes out, it's a step down process, so it takes time. So hybrid is here to stay. And typically I saw another report and a couple of things what we say is that when a culture changed with a big shock, it takes almost a decade to go. Let's say, 50%, but still the point is hybrid is here to stay. It's gonna stay for a long time. It's gonna stay longer than we're gonna be in a business, right? Everybody's saying 8 to 12 years before a behavior changes again, or a big shock like COVID happens one more time. Number 4, refinance without cash flow will not happen, right? As you know, everything is depending on cash flow. So for us, we are very active in the office market because Massive is growing. We'll talk about it. We need to find an office. For us, we are right now, today I walked an office. Last Friday, we walked 2 offices. So right now in Houston, 1990 and above, pretty Class A almost, B plus Class A buildings are going for $45 to $60 a square foot. And the current building costs at $150 to $180 a square foot. And the biggest driver that we have seen is the tenants are resizing. When we do the lease audit, most of the tenants are resizing. Then I'll show an example. Or they're consolidating. They're taking 2 or 3 offices, they're blending in together because nobody shows up Monday to Friday. And one office, they do Monday, Tuesday, Wednesday. Another office, they do Wednesday, Thursday, Friday. So there's a blend, right? And also inflation eroded the value of money. Buying power of $10,000 3 years ago, it's not the same as today, right? So if you blend it all in, If everything depends on the cash flow, when tenants are walking away, nobody's signing it. And issue is each of the tenants takes a big chunk of change. So by design, office is going to take a big bidding. On the other side, on the flip side, what we also saw, the people are walking away, but they're walking away from a little bit older buildings to the nice and fancy and class A location type buildings. Imagine, right? Somebody's walking away from a building, they're going to another building. They have to go somewhere. And that's what we're seeing, that poor locations, poor assets, and I would say 2000 plus buildings that look good, or 1990 that look really good, those are getting all the tenants. And so that's a hard data point. I saw a property today. They said it's a distress. It was almost 70% occupied. There was an engineering company, took about 70,000 square footage or so. The building was 150,000 square foot, and the engineering company walked away from the building after 27 years. And the equity company bought that asset in December 2021. And it's a distress, going to foreclosure auctions, and they're going to the market for $43 a square foot. Just to build a garage, it takes around, I would say, almost $48 a square foot, including the land. Just imagine someone who's going to buy the building, you buy the land and the garage, you get the building for free. On the flip side, you have to really see that can we, or do we have enough skill set for that general partner team who can buy the building and occupy it by competing with the other vacant buildings, right? That's very interesting way of taking a look at this. Office is the worst asset class right now, but on the other side, if whoever has the money and also the team is very comfortable to lease up, and they can weather next 2 or 3 years or so, they're going to get the best out of it. So left side is the issue, right side is the example. That team with the $60 million, they will make a big chunk of change when the market turns 3 years out, because they have the liquidity and they have whatever the internal capacity that they have, they can float for next 3 years. So cash is king and the cash flow is important. Without that, if we have to refinance today, it's a very tough spot to be in, right? So that's the biggest one. And then I'll talk about the second one, multifamily value add, right? It's going to be interesting for all of us. So on the right side, I think all of us here, you guys have seen that. The big Wall Street news, 3,200 units for the Apple's Way. On that note, what Trevor was mentioning, we underwrote a little over 300 properties this year. We underwrite about 15 to 20 brand new assets at a weekly basis. Me personally, almost every 7 to 10 days or so, I'll walk a property which is upside down. Last weekend, so I'll give you an example, number 7, then I'll walk my way up. Last Saturday, I got a phone call from a friend of mine from Dallas. He said, youÂ're, there's a property going on to the auction first week of next month in the Harris County. They bought, it's a little over 400 units. They paid all in $47 million. And the loan is at $32 million. They're saying, can you buy the property at a $32 million? They're going to walk away with the $15 million loss. Pref check 7 or 8, and the rest was retail. And I walked about 6 or 7 of those last 2 to 3 months. So what we understand is that is here to stay. You could have a good operating team. You could have a good location. You could have a good CapEx execution. If the rent growth and the rate cap isn't there, mostly the rate cap, that puts a big impact on the cash flow, right? And a dominant part of the team who are putting the deals together, they don't have the balance sheet and the liquidity from their own fund to float a deal, 100 units, 200 units, 300 units. So back to the case in point, when you look at it, one of the questions you got to ask is that, hey, what is the balance sheet of the GP team? What is the liquid of the GP team? And if things go sideways, which it does, can they foot the bill for 3, 4, 5, 6 months, a year or so? That gives you the confidence level who they are, right? Multifamily is an expensive game. It takes a lot of money put together to do a deal, and thing happens. If that's were to happen, the GP team needs to be strong enough to weather that, as you kind of go through. So that's number 7. I'm going to go down from the top, right? As you can see, since, up until last year, summer, everyone purchased on a pro forma. And so we bought one asset in pro forma. And then on top of that, everybody wanted to be a general partner, right? And what we see was something called zombie assets. There are lots of assets that doesn't cash flow. It's not a good location. Execution wasn't there. But when the market rights, it washes everything. So those zombie assets have been handed over a couple of times. That's there. And then another thing which everybody wanted to be an operator. Somebody became an LP for 2, 3, 4 times. Market turned, they made money all of a sudden. And I can be a general partner, forgetting our skill sets are. So at Massive, what we say is that relationships are built on a skill set, relationship, and the relationship will happen after the skills, right? And for us, last year, when we did all sorts of modeling, we thought we know it all. That we thought that interest rate will hit this high this year, not last year. And so on that note, we made some assumptions. So it worked out for all of our assets post-April that we purchased. And we did expect last year, it was a steep V curve, which is there was a hard reset will happen by the Feds. We're going to go to recession. We're going to come back out. Now we believe it's a U curve. We are like it's a V curve with a wider angle per se. We'll slowly get down to recession, and then it's going to be a long time to get out. So at number 6, we underwrite 10 to 15 assets and 1 to 2 upside down deals almost every week. It is tough. It is sad that so much money being eroded out, but on the other side, it is interesting in today's time if you can make a deal happen. Right. So we also saw land. I didn't put it in on the land side. We saw around, I would say 15 to 25% haircut on the land price. That happened today already. I don't have the cases for land, but we buy a lot of land as well. So in other way, whatever, if you see a land listed for $10 million, you go make an offer $7.5 million, they'll love to have a conversation with you. We have seen the reset price. Now putting together, what we say is this, that how do we weather the next 3 years, right? As we have 3 ways looking at it. Number 1, we said we took a position that we're going to go and play with our skills, and the skills need to be in-house. And then what we're going to buy, price needs to be reset, which is everything needs to be at a market rate. If you ask us what type of loan we love the most, we may sound crazy. Any kind of bridge loan we love the most. After that, agency. We do not buy anything that has a less than 5% assumable interest rate, because then we'll end up buying the property at a low interest rate, but when we sell, we have to sell at a high interest rate. It just doesn't make sense. So for us, we like to buy, based on our skill set and based on the market rate debt, and then the primary market. We are avoiding right now on the tertiary market, and try and be gentle about the secondary market, but our focus is on the primary market. So we took the primary market, then we cut it in a couple of different ways to avoid anywhere that has an insurance, that we are not exposed to it. And also the property tax will tend to go up too high, too fast. So in-house skill, market rate debt, and the primary market. That has been our strategy for almost a year now. So what does it mean? That skill set for the in-house, we call it market positioning. So we spent quite a bit of time since last year for almost half of the folks here, and that you guys are following and working with us and investing with us since Q4 last year. We spent a lot of time to build a team rather than hunting for deals. So now we have some good stuff coming in. We've been very objective and focused on buying or being a part of or margin on a land development and the construction companies. So we can have it in-house, so we can control the cost, we can control the design. We are on a better side of it. And there's some exciting news to come in about 6 weeks or so. So stay tuned for that. And as you can see, we have done quite a bit of new construction project as well. We have done land development, we have done construction, and those are very intentional about doing so, because as we do those projects, we get exposed to those teams. And if we can bring the team with us together, it's one umbrella and it's much better, puts us in a very good place on the market. Second thing is the balance sheet. For us, what we believe is that when the downturn happens, team with the biggest balance sheet will be lendable. That means we can get money where others will not. So we have built a strong balance sheet between us and our partners. Also the liquidity. So what we believe is the balance sheet will get you through the downtime, and the liquidity will get you ahead, and team will put you on a good side of the market when it turns over there. Deal flow. We spend quite a bit of time, as you can see, to build an acquisition team. We have 3 full-time. Behind us, we have lots of our friends. So we have 25, 30 of us. We're running deals together. So we have full-time FTE with institutional grade softwares that we use to underwrite deals, investor relations. I like to say we have a team who likes to over-communicate, and I love it too. That's that. And also, we thought as we are building it, we have deal flow. That means we have data points. We have investor relations. That means we have softwares. And if we have the balance sheet and technical skill, we can help others from the hard data, not from theories, right? Everybody can say to be a scientist, you just go to college for, 4 years undergrad, then 5 years or 6 years of PhD, and you're done. But that's not the reality the case, right? And for us, we believe we have a lot of hard data that we can share with the right folks who can be partners with us as we go through. So that's that. Second thing is the asset class and price reset, right? Back to the market rate. Right now, what we're seeing is that from our decision hierarchy, it's assets with the price reset that happened already by design with the new construction, lease up, and retail triple nets. Anything that new that's coming onto the market today, no cash flow in there, they already have the price reset because you cannot, they're not stabilized. You cannot debate about whether it's 8% or 10% that. We're looking at our offices with a heavy discount, like a deep discount. I give an example of it. I just imagine $40 a square foot. The land alone is $30 a square foot there. You get a building for $10, and if you can do it for next 3 years, we're fine. And also we are doing multifamily value adds in core markets. So, some of the webinars we talk about what our core markets are, but we are doing those, and that's our decision hierarchy is put together. Projects and location, it's all about the local knowledge. That's our in-house skill. We're doing retail, new construction, triple net, focus in Texas, multifamily construction, focus in Texas, land development is Dallas, Austin, and Houston. We're looking at distressed multifamily only in core markets and distressed office only in Houston. And we believe that we're going to have enough mess in the system, enough blood in the system, what we call it, that our capital that goes in, it must be in a stress scenario. And anybody who is selling it today, they must have a need to sell it today. And higher the need, the better the conversation. It's number 4 and 5 is there. Number 3, and 2 and 3. As you can see, 1, 2, and 3, that requires also a different type of team and a different kind of skill set that is not typically easily available. And those teams takes 10, 20, 30 years to build. If you take the right 1, 2, 3 and go back to the left side, number 1, technical skill, that's where we're very keen about partnering up with construction and the land development, which we are doing, and we have news coming up in 6 weeks or so. So that has been our strategy, and roll that back in. If you go back and you'll see how we have done it. As you can tell, Austin, it's a very good market. It's a core market for us. Dallas is a core market. Value add, that was a cash flow market. Again, we're back to Austin, back to Houston, and we are Denver. So Denver for us is a very good proxy of Austin. So we are going to 2 of the great markets, and also we are in Texas as you kind of go through. Interesting part, Florida and Arizona. I'll talk about the Florida a little bit. That is a fantastic market, but not for multifamily today. Multifamily today is getting killed by the insurance. State Farm walked away. And so we believe that Florida is going to have a hard reset of the price. Biggest reset will be from the insurance, same as Houston. And for us, we are keen on the triple net there because we are not exposed to the insurance and taxes. That is going to be our tenants, right? So that's what it is. In Houston, it's a very similar thing. Value add class Cs, we are avoiding it a little bit more, unless it's some of the sectors of the Houston where you have insurance less. But south side of Houston, we're not touching it because insurance is going up 50%, 60%, and we just cannot underwrite anything at a 50, 60%. On the other side, class A seems to be a very good spot because Houston is, people are moving, revenue is growing. Triple net makes a lot of sense. Again, taxes and insurance. It's a net basis. We are not exposed to it. Tenants are, and that insurance and the taxes, especially insurance, it doesn't go up at the higher rate. So Houston is a very good market for us for triple net and a Class A assets. Dallas will open for C value adds and new construction. Austin will do everything. San Antonio for us as well. And Carolinas and Denver will pick up any assets in those markets. And Georgia, it's purely cash flow. That was a lot of information. I went rather quick. So I'll pause here, open up for Q&A, right? And I guess, yeah. And then we have our next session coming up, I guess. Now, Trevor, back to you. You want to take it from here?
So we have our next session. It's going to be phase number 2 of what we're doing. And for some reason, the whole screen, I can't read the very bottom of it. We cut it off there, but it's the, oop, what did I do wrong? All right, yeah. So finding the hidden gems in the midst of the market bloodshed. There are still deals to be had, and you just got to know how to find them, how to underwrite them, how to look at them. So we can go do some Q&A now. That was a big data dump download.
I know, that was a lot. Thank you, everybody. Ask all the questions.
I'm assuming that we're going to have some questions. So maybe if we stop presenting so we can see everybody, raise your hand and we can unmute you, or you can put, so they talked about Houston. Are we looking to buy office space and convert it to multifamily?
Okay, so I'll go backwards. Thank you. In Houston, there's no zoning. Yes, that's right. We're not looking into converting to multifamily. We tried, and it is a very complex thing. And the issue becomes when you look at the egress and access. So we're looking at office from the purely office perspective. That's that. So, and our hypothesis for the office is, number one, the team has to have some market know-how to get more lease up compared to others. So I'll explain why we're looking at office. So Massive has a Houston office around 10,000 square footage. We are partnering with another company. We're going to roll up into one. They have another 15,000 square footage. Put together us, we are taking a space of 15 to 25,000 square footage. And that company will bring in a construction arm and a property management arm and a brokerage arm. So we have a lot more expertise in-house within our company that can get more tenants compared to a GP team who are going to hire CBRE, who are going to get a third-party management company to run a building. We're looking at from that bias that we'll be able to control the whole workflow, to shrink the time to get the tenant in. Plus, we have our space that we need put together. If we can buy a building in a good place and a good size in today's market, we should be in the cash flow. Plus, we have some other stuff we'll talk about it one day, but that's why we're looking at Houston. We have a specific rectangle space that we're looking for. It's built away to Galleria, and that's the zone we're looking for. And there's, we have two LOIs pending. One offer is going out today, so it's working.
And another interesting point on it too, if you're not an expert in that space, no matter how smart you are, it's a good way to mess a deal up. It's a good way to risk people's money. Like there are some people I know that when COVID came, they did hotel to living, and man, they got killed because they weren't experts in the space. Now, there are experts in the space doing really, really well at it. I've got a couple of friends who've done some conversions, but boy, if you miss it, it is super painful, super painful. So you've got, again, that's why we align ourselves with, if you look at 90% of our deals, we've aligned ourselves with experts in an area or in a space or in a market.
Good question. I think Andrew asked, I explained primary, secondary, and tertiary market. So Andrew, I don't know where you're based out of, but I will use Houston example, right? So Houston, it's a primary market. But if you go Silly, Columbus, on the past Katy, that's your secondary market. And if you go Brazoria down south, Corpus Christi, that's your tertiary market. Less the population, less the movement, less the the economic growth. That's how we take a look at it. So that will be one way of taking a look at the primary, secondary, and tertiary market.
And you can raise your hand and we'll unmute you too. We love questions, so don't be afraid. and there's no no taboo questions.
Oh,
If you
100%.
don't know the
Ask
answer,
away.
you try to find them out.
Okay, as you guys ask the questions, come on, we appreciate questions. What I will show you a little bit, how sometimes we drive decisions, right? Trevor, keep a look at the Q&A. I'm going to share my screen, if that's
Yep.
okay, please.
Yep. And good to see many of my friends that
Hey,
got on.
youÂ're.
Hey,
Can I share some stuff to plug a
Please,
little bit real
please.
quick while you do
Yeah.
find your thing there? And just a reminder to everyone, so we do want to, share even more. Oh, I was going to share my screen. So
go
I
for it.
put back in the chat real quick is a link, which is a pretty, cool link to rather than going, you have the option to go to our website. Well, we also have this link to go to this page here, which is basically, we call it All Access, Massive Capital All Access, which has a lot of little buttons that you can pick on stuff that you're interested in doing or following with us. So, including signing up for future Wednesday webinars, getting access to previous webinars, the Massive Capital Girls Society group, as well, introductory calls with us. Cool thing we have is you can submit your deals here directly, give some information, what deals you have, that goes to Brad Pickett directly, and him and the team will take a look at those deals. Signing up in the investor portal, and then our coaching program, which will go to Senate and Brad as well for people that are interested in any of that. And then a couple of cool little free items, the IRA ebook and a passive investor checklist. So take a look there, log in, get into that stuff and take a look with us. Signing up in our portal, Jasmine, I think will share it again, or Trevor. But if you sign up in our portal, there is no obligation. It just continues to let you see the deals we're doing and an opportunity to keep connected with us, over a continuous basis. So just wanted to share that, Schreier, and I'll turn it back to you and Trevor.
Awesome. Thank you. Let me share my screen as it goes. So I will share you two data points. One is the interest rate increase, and the other one is on the office. But before I go, I saw two questions. One raised hands. So Jaden, would you mind? Yeah, unmute.
Yep, I think you're good.
So I guess I got a quick question. So if I know everybody's got a different way to kind of do their napkin underwriting, to weed through all of the garbage and look for the diamond in the rough. So what is it that you guys would do to do your napkin underwriting?
Sounds good. So that's a loaded question, right? So let's say someone sends me a deal, and the first thing it's that why we're going to take a look at a deal, right? What's the story behind it? So there got to be a story. So everything starts with a story. Either the property owner had the property for 20 some odd years, 5 years, or they are a retail, fund they want to get out, or rate cap is expiring, or the business plan is finished. There has to have a story before we can take a look at it. And we have some stories we like to get deeper into it and not, right? So if someone sends us information, the back of the envelope test will be, the litmus test will be, let's go take a look at the story, what the story is. Number two, do we own any assets anywhere close to that property? If those two checks out, we get into the exercise. And the exercise is a pretty detailed exercise. The biggest time, or the most amount of time we spend initially, is understanding the rent roll, which is the characteristics of the property. Then we bring in our own hard data to figure out the cost. And then we also have lender data to get the debt side of it. Then at the end, we do another test, how much of equity is needed to get a deal done. Our investor relations team, including all of us, we're actively talking, actively raising. We have a good pulse what the market wants, what the returns are, and we factor that into the deal. Then it says, does it make sense? At the end of the day, also, we're going to ask return on effort, ROE. ROE is a KPI that we measure. At some time, there are some deals, so just because some of the folks were gonna do the deals because of, their reasons. But we are not doing a deal where return on effort is very low. We're not gonna go into a class C minus area with a bulletproof vest and we have 100% of the units where I have to pay 10% and clock is ticking against us, market is on the sideways. So it's a little bit more detailed than us. So we don't do that much of a back of the envelope for us. Thank you.
Hey, Trevor, are you watching the Q&A as well?
Oh, I'm sorry, just let me get, yeah, so
To the right side, the Kyle asked about, it's a good question, Kyle. So for us, we underwrite, I want to go back first on the first question, bottom first and top. We underwrite, depending on the deals, if that's a new construction, we want, 2 years in and out, plus minus 6 months. If that's a multifamily value add, we want 5 years in and out, plus minus 2 years. And then if that's a new construction multifamily, 3 years in and out, plus minus a year. And that has been our sensitivity and core underwriting. So that's that. And each of the asset class has a different kinds of underwriting because we're exposed to different kind of risk, which is why the returns are different from the asset classes, because for us, it's not the return, it's the risk adjusted return. And that's what we should go after. And that's how we take a look at it. Everything on a risk adjusted return. Risk profile is different on a different types of projects, but it's 2, 3, and 5 that have been our underwriting philosophy to do all the investor forecast.
and they're talking, there's a question on time frame of capital. What do we, or cap rate, pardon me.
Okay, cap rate. So our belief is we are higher for longer. So if I buy a property today that we're gonna sell 2 years from now, so we're gonna sell at a pretty higher interest rate, as well, which is very similar to today's. So we believe in a year and a half, 2 years out, I will be more or less at today's interest rate, maybe minus 50 basis points, and that's that. If we forecast 5 years from now, so we said, okay, hey, at a base case, we'll do at today's rate, but we'll do some sensitivity to see which way we kind fall. So that's one. Other way, short term, same as today. Long term, a little bit lower. Long term will be 5 years out, and then we run sensitivity on top of that to make sure we are in a good spot. Whole idea is that we want to minimize the downside, and we want to stay close to the market. So whatever it goes, it goes. Then
how are our deals performing based on our projections?
Got it. We have done total as of 14 deals. Last year, we have done 8 deals. And from the pro forma revenue perspective, 100% of our properties are ahead of pro forma. One of the asset had a rate cap. We bought it at a 4 and one at a 6. Our revenue has been eroded out because of the interest rate increase. Except that one, everything is ahead of schedule in terms of revenue, OPEX, CAPEX, and NOI. So that's that. We have one asset that was the rate cap 4 to 6. Beyond that, rest of the portfolio is at par, if not better, for all the categories that we have. Fantastic question.
And Alex has his hand up. Go ahead, Alex.
Yeah, I had a question on your rate caps. What's the typical timeline or the time frame of the rate caps that you're purchasing? I'm asking specifically because I'm curious to see if we see projects not specific to you guys, but just in general getting in trouble even though rate caps have been purchased.
Thank you. So we have not bought, so since now this year, we have not bought any deal that required a rate cap. And that's also because most of the deals that you see underwriting and going back to balance sheets, almost dominant, almost 99% of the syndicators, they don't feel comfortable doing recourse loans. We feel comfortable doing recourse loan because we like what we do. We are vetted in it. So we try to put fixed debt on everything, even though it's higher rate. So last couple of deals that we have done on the land side of it, those are all bank recourse loan. We signed the loan. Everything has a fixed debt. So for the next 24 months. And then the cottonwood that we're doing, that's a fixed debt, but it's an agency 5.5%, a little over 5.5%. So long way of saying, well, Alex, we haven't bought anything on a rate cap because, we want to pay highest interest rate, which is okay. And then we kind of go from there.
Thank you.
So there's a question here in comfort with bridge loans. And then, what type of property, so sorry, make sure I get this right, bridge loans and debt closure current to market cap rates, and what classes of properties do we look at?
Oh, that's it. I love this question. So we got to have a decision hierarchy, like what's first, what's second, what third, and then we can go align it, right? For everybody here, if you underwrite a deal, you need to know what your decision hierarchy is, right? Our decision hierarchy is we want to stay close to the market. That means I want to buy with the interest rate that is closer to the market because I'm paying based on the higher interest rate, right? So we are comfortable all day long, we'll take a bridge debt. Because if you take a look at the interest rate curve, what's happening? We already went up, we're at the peak. One more hike, maybe 1.5 hikes, half a points, and then it's going to stay, then it's going to go down. So we are on the top. So how high you're going to go? If they make me buy a rate cap for 0.5% interest rate, we'll buy it. But we believe if you get a bridge debt with the high interest rate cap buying will be waste of your money. Because we are paying 9, 10, 12%, depending on the deal that you do. So we are extremely comfortable. Now, on a bridge debt, what we want to buy, we want to get a new construction. We want to get a retail. We want to avoid a bridge debt on the office, right? It's a two ticking bombs together. Now, on a bridge debt, if you use a multifamily, that better be a deep value add. And that's how we kind of go for it. So long way, we are extremely comfortable, but depending on the type of projects, we'll do bridge debt. And then when we do the bridge debt, we take a look at it, is that if I take a recourse loan bridge debt, then master team has to have some differentiating factor from the market when we go to a bank. Case in point, we have great relationship with 3 credit unions here. We took, on average, each of them 5 to 6 loans, and we paid them off. The Georgetown deal that we have done. So I go to broker, they say, yeah, on a land deal, you get 50%. I said, no, I'm 75%. One of the broker told me I'm crazy. I am asking for too much. I said, that's fine. Our team, we went to a relationship, we got a loan. It's a 5 years fixed, 30 years IO, and we got 75% LTC in today's market. And that's the whole bias, right? Can we get more out of a relationship based on our balance sheets, based on the deal that we do, and still make a deal happen where others are not being able to do it, right? Having a deal where you have 25 years IO versus 30 years IO, having a deal with 75% LTC levered at 8% versus 65% makes a lot of difference. So we look at a lot of things, step by step.
And then they talk about, I don't believe have any deals that are affected by increase of interest rates because we've been fortunate. But for those that aren't, what would your strategy recommendation be other than hunker down?
So we need to be professional, right? So all these indicators to me are money managers. And life, it is life. If you walk, you're going to fall down. If you walk a whole lot, you're going to fall down a whole lot, right? So at the deal making perspective, at least if you ask me, we're going to have, next 10 years, maybe we can take 20 shots. We can buy 20, we can trade 20 properties. Our goal is to put all of our investment in such a way where a dominant chunk comes out with the profit, where 1 or 2 goes bad, which is normal. So for me, so if someone is a bad, what I would say, number 1, step down process, dilute your position from the GP perspective, raise money to float the deal. If you dilute it out, dilute that first. Don't go raise money and to dilute the LPs, right? Dilute the GPs first and then get to the LP. And then do analysis that once you bring in the extra cash, whether you're in or out or not. So you need to be very emotionally unemotional at this point in time. Just look at a deal. Sometimes it's a losing game. Now you should not bring bad money into a good deal. We should bring, good money to a good deal or good money to an okay deal. We should not bring good money to a bad deal. So at some point, if it's a losing battle, you have to say I lost it. And then we owe to the investor to go back and make the money again down the way, right? So to me, if I think it's a lose-lose game, we need to take the lesser of the evil and come to the second one. Don't be emotional about it and lose everybody's money. I'll give a case an example. September last year, there was a property in San Antonio. We were negotiating with the seller that, hey, give us the property at a $24 million. He was stuck at a $29 million, not a dime less. Month and a half ago, he went to foreclosure. Same seller. That to me, it's a bad operator because you have done one deal on 2 deals in your lifetime. You get emotionally attached, you drain the property, and you drain the LP's money, and you drain the whole thing, right? So to me, if the market turns, pay attention to the market, right? You don't have to get the home run. Just win 1 or 2 and get out the door. Score and get out the door. Not everybody is there. On the flip side, one of the person we look up to, he flipped his $350 million portfolio completely right after COVID. He went from he saw the whole thing coming. He went that into new construction all the way. And the person who bought his $350 million portfolio, he's hurting bad. And he's looking good on the other side. So my thing is be professional about it, be unemotional about it, know the market, look at 3-4 years out, cut the loss if you have today, and move on to the next one.
So next question is, how do we attract our high caliber partners? And the quick answer is we kiss a lot of frogs first till we get a prince, right?
Lots.
That's the quick answer.
Couple of those.
How many
Yes.
meetings do you have? We have, and you kiss a lot of frogs till you get a prince, but you don't marry the frog.
And we all been through our fair share of it, right? So
That's probably a very oversimplified version of it, but it's spending time, and sometimes months and months and months and seeing what happens. And I know you've had a relationship with a couple of our KPs for several years now, and it's when you reach into there, they want to be a KP with a quality team, so it has to be a good match, right? Because they don't want to sign on debt for all those ones, and then end up in foreclosure.
So I had another question about looking forward. What's our new exit strategy for the property revenue been eroded? Okay, we'll give an example. Pasadena, we have 234 units. We bought it at a little less than 4 interest rate, went up to 6. We strongly believe the market is extremely efficient. What do we have today is a snapshot of today. What we're going to get 3 years from now is not the same as today. So it's a cycle. Interest rate goes up, we foot the bill. But we all are capitalists. This is a capitalist market, and we are waiting for market to turn a little bit. We'll bump up the rent. We expect 1.5 years, 2 years down the way, Houston will have a big inrush of rent increase. When that rent increase happens, interest rate taper, that cross point, that's what we're going to sell. So the whole point is survive till 2025. You'll be in the money again. From now till then, question is, can we survive? As long as we don't have to sell now till next year or so, just go through it, pass through, and you're gonna go. Great questions. I love this.
Yeah. We're almost at the top of the hour. Just so you know, nothing magical happens at the top of the hour, other than you can ask anything. Doesn't have to be about blood in the streets, doesn't have to be about anything. We get asked all kinds of questions, and again, this
all kind of crazy questions too.
Pardon me?
All kinds of crazy questions too, right? Which is okay.
And so just to make sure this happens every Wednesday, the whole goal of this is to provide education, insight, to share what we're thinking. And we also, with the questions and with listening to people, we learn what you're thinking. Because again, everybody learns if everybody shares. So that's the whole purpose of what we're doing. Magena?
Well, good afternoon, good evening, good morning, depending where you are in the world. So good to see you, Shariah. Thank you for pouring into us. This is awesome as always. I'm curious to know a fun fact about you. Who is Shariah outside of real estate?
Dang. Oh, I read a lot of books. I have a stack of books everywhere I will go. If I get 3-4 hours, I read a lot of books. Second thing is I'm a cartoons guy. It's anime. I love it. I'm 40s, but I still love cartoons. when cartoons happen, my wife is so mad at me. I was like, why are you sitting down with a 10-year-old kid? I was like, I love it. So the cartoons, anime, and books, that's outside of it. Thank you.
And you can use 401k retirement funds. So what you need to do is you normally need to move them from your work custodian, assuming that you're no longer, employers don't like you take their money out. But if you switch it over to a self-directed plan, there's several planners that are out there that take care of it. So you move your funds from your current IRA that you've got out of her 401k from your work, you move it into a self-directed, then you can use those funds to invest in a syndicated real estate deal. And it happens. And in fact, on the first Saturday of August, one of our providers that we work with, I'm actually doing a webinar about how to use your retirement funds to invest in syndications. It's a great asset class to do it in. And there are certain types of deals that make more sense. So for example, our land deal in Georgetown, X-Space, and our new deal coming up here in Austin on the retail, those properties are actually very well suited to use your retirement funds for. I'm not an accountant, I'm not a custodian, but it is there because there are things that you get with a cash investment, such as depreciation, that happen on certain mostly multifamily, and it doesn't happen on the other ones, but they often have a higher return, and they often don't dribble cash. You come in and you get out, you know. So for example, on an X-Space, you put 100,000 in, and 2.5 years later, we put another 50,000 back in, and you don't have to work with, dribbles coming into your, where on your home, you may need them to live in your personal life.
That's so cool. On that note, though, Trevor, depreciation, right? Tax season is coming up for the folks who are doing late taxes. I understand this is the time we all should talk to our CPAs, figure out the tax strategy. And for all of us who are paying the taxes for the next 45 days or so, keep in mind, depreciation this year, 80%. Next year drops to 60%. So the synthetic loss, the K1s, they are tapering down as we go. And on the corporate side, I left Shell a year ago. One of the things that I learned, I had a pretty cool laugh at it. If I leave my pension amount within Shell till my retirement, that would grow at a 3%. So I'll be out of money in year number 2 based on the inflation. So it's a little cool nugget to that one. So have your pension, if you have with somebody, go back and ask how much is your pension growing at, so you can know which way to go.
And there are no limits of what you can do other than any limits that are on cash as well. So there's no differential. So some deals have limits to how much you can invest in it, and it has to do with the percentage of ownership of the shares. Once you reach a certain level, you no longer can be considered a passive investor, even though you're not actually doing it. But you can invest with your retirement funds exactly the same as, and I personally have 7 investments through my retirement accounts. It's a great way to build your wealth.
There was a question from Divya about how to look at the deal, some of the KPIs, right? So I'll give you at least how I take a look at it. For me, I start with the GP. Majority of the deals that falls out is because of the technical skills of the GP in my world. So that's one. So what does that mean, right? Sometime at least every GP's combination team has a risk associated with it. So get comfortable with whatever they're at, right? Some GPs been here for a long time. Some GPs like us. Some GPs are brand new starting, right? As long as you're comfortable, it's all good. So make sure you understand the GPs, understand, what technical skill that they're bringing in to look at it. So when you look at the multifamily investment, think about you're not buying a property. Don't think about you're buying 40 houses. I know a book says, everybody says that way. Think about you're buying a company that is worth 5, 10, 20, $30 million. You're going to bring in a CEO, COO, and CFO to run the asset. Then you ask a question, why that team giving me confidence to run a $20 million company and sell that thing at a $30 million 5 years out? That's the clear framework to take a look at it. And then you take a look, how much are they making? Think about this way. You hire a 4.0 engineer who has been there, done that. Their salary is different than you hire a 2.0 who never been there, done that. GP team is just like that. So a clear line of sight will be 90-10, then 85-15. To me, those are extremely red flags. When a deal doesn't work in a typical path, you start chipping away, give it to the LPs to make the deal happen. Or on the flip side, we're in a deal doing business, right? I don't do one deals, we do many deals. And if someone is incentivized by not making money, obviously that team will do multiple deals by design. If they don't have if they're a full-time job, or then they're doing a general partnership here, running 5 assets, we all got 24 hours. So your deal is gonna have some hiccups. So run that by on the GP side. So I like it when the GP team makes it because they're incentivized. I can go and ask, hey, how much is your time without even saying it. And the third thing we take a look at it, how much time commitment that they have. Not massive. We don't partner with others who has W2 and want to do 5 deals because they already allocate. I love them. They're fantastic. But at the same time, they have allocated 60 hours of time somewhere else. What they're going to do, what happens on that side, right? Either we have a pathway of coming full time or they're into the business full time. That's the folks and that's the set of people we partner with. So when you run those 3, that what are their CEO, CFO of that X amount of $1 million of the asset, and you bring confidence there. Number 2, they have time allocation. And number 3, they bring some kind of a skill set from whatever that they're doing. Then within those 3, you'll see whether the deal is going to work or not. Then you get into the deal. And in the deal, the assumption matters, right? But run the qualitative, then you get to the quantitative. Don't get all high about my, my return, right? Because returns are risk adjusted. And so just, know the team, know their assumptions, see them on everywhere, go shake hands, then you go.
Absolutely. Yeah. First you invest in the jockey, then the horse, then the track. And you got to make sure that all 3 of them know the market conditions in all 3 areas. Awesome. Well, we appreciate everybody coming in. A couple of people had asked about, we send the replays out. I actually posted the link to our YouTube channel where all past webinars are put up. There's lots of other content there as well. And again, we're not throwing you out. We're just saying that, in theory, we're at the end of it, which I guess we should rename it like Anything Goes or something, because we tried doing the happy hour, but we get too many quiet people to have a happy hour.
We should say something that it's like not happy hour. Happy hour to get so lame duck, right? It's like crazy hour or something like that. It's just, you ask whatever you want to ask, just be fun and have fun with it. Push the boundary a little bit, right?
Yeah.
Now, thank you, everybody. And I know it's the middle of the week and you guys took your time to join our webinar. I see a lot of familiar faces. We truly appreciate you guys giving us all the time, especially for those who are investing with us. So thank you.
Yeah, and invite your friends. If you enjoyed it at all, just always invite your friends. Anybody else got any questions? Are you clapping, Barbara, or do you have a question?
I was clapping. No, it was great content. And, and I know a lot about Massive, but there were new things I learned too. So have to get, internally more involved as well. So it's on my to-do list. So this is, this was great information. Thank you.
Let me let you in on a secret. I learned stuff too, and I'm very involved in Massive. I have a joke that I go to bed and I wake up in the morning and everything is different.
Hey, and that's the beauty of it, right? Sometimes you talk to Sanjay and Trevor and Mike, we thought I'm in sync. I wake up and next day after 10 hours, they're like miles ahead of me. I was like, well, what just happened, right? How did you get there? Hey, Trevor, I forgot. One thing we should share that we are going to have a virtual conference coming up. So Massive is rolling up. So we have our weekly webinars and we have, the Growth Society as well. So we have underwriting webinar as well. But now what we're doing is that as we're doing the weekly roll-up and weekly webinars, we're rolling up to a quarterly conference. And there's a conference coming up in about 6 weeks or so. Please stay tuned. We'll send you the information. Our approach is it's a little bit more academic and then on the ground. Less of a, I would say, book conversation, right? We all know 1 and 1 is 2. But when you get to the battleground, trying to put the 1 and 1 is different, right? It's just we're going to have that really good lineup of speakers, really good agenda. I think we finalized the agenda. Date is fixed. Website is ready. So we're gonna share with you guys. Please come over and join. Looking forward to it.
Come on, Liz, you got to say something. Liz,
Oh, you
always
know, I
counting on
just-
Liz to say something. Liz
I
is my new buddy. I think we talk all day long.
I think you just read my mind. I clicked unmute and you started talking, Trevor. Schreier, you know, I've heard you say about the interest rates on another call that we had recently. And you say that it's going to have one or two more ups, and then it should stay there for a while. What do you see as being that timeline until we get some relief?
Short answer is I don't know. Right? I'm
Yeah.
gonna have to make an assumption, right? So
Right.
our assumption is it's gonna be at least a year and a half. Because what we do understand that the model that we have now, it's gonna be a version of 1980s interest rate. You know, the issue that we had back then, we went up, went down, went up, went down. The Fed's coming out saying that we're not gonna do that jigsaw, we're gonna stay. So that's one. And then what happened here from my cost basis perspective, 50% was real estate, other 50%, from the 30% of the other 50% is service oriented. The real estate came to a halt, right? Everything came to a halt. They brought that thing down. But the other 30% is not going down because my job market is hot. And they have to bring the job market down.
That's
And
their
for
goal.
that,
right?
that's the
Yeah.
goal. But I mean, to me, it's healthy, right? Stomach is all messed up. You take a beating today, but a beating later. So you just take it now and go get that later, right? So to me, it's not happening. Job market is still hot. And that's also because for a business to make a choice, it takes a lot of push. So if you give a little bit more time, that's going to happen, hopefully so, and so we can get out of it, right? So I believe, I mean, that's our take as of now, what we understand, looking at some of the information and our position is about a year and a half or so, if it's the tapering out.
You do attribute the job market related to the AI development and jobs around that, trying to learn about and harness this new entity?
I don't know. I mean, I feel like AI is going to make even more efficient, right? We are getting more efficient about things. And what does efficiency mean? My revenue goes up, right? And that's one. And that's where I just struggle. I just don't see. I see a slowdown impact, right? Real estate slow, that happens. And we thought at some point one of the job sectors will go, and that and the whole web tech on the California side of it was popping. Sorry, bank was popping. So bank has a relation to it, but bank we got stopped. And now the bigger worry that we should have, Fed's asking the banks to refund, or not the refund, to work with the general partners, with the larger asset owners to reset the loan. So it's kind of like we want you to do certain things, but I'm going to give you so many help outs that you don't get that, right? The COVID money is here, then bank bailout is here, and we bail out the larger property owners, then where's my fallout? Until we make some Fs, we don't know how good of what does it take to make an A, right? So I feel like it's going to drag a little bit more unless the Russia war fights happens with that's something. So
Got it.
Do you think pressure on if the new administration starts going in the polls and they make it a because clearly whoever could be come back again, clearly going to try to do things about the economy and real estate and interest rates. So I wonder if that becomes a moment, will they have to adjust to compete?
probably so. Then there's going to be a bias, right? The politics has a way to kind of get in it. If I'm in the middle of getting votes, I'm asking you for my vote. They don't have backbones, right? They want to tell us whatever we want to hear. So of course they're going to make you happy. So if election year is always the touchy point of it. And I saw somewhere some probabilistic report, don't quote me, I think, but what stuck with me is that if there's blue, and a red, the likelihood of recession goes up. I don't know how they got to the valuation model, but I saw that report, I was like, but that kind of stuck with me. And so I don't know what it is. And for me, it's like buy asset classes that gives you the 2-3 years right out, buy asset classes that has pricing power, buy asset classes that has organic demand. And if none of those checks out, then have a steep discount so you can still get away and wait till next 2 or 3 years.
An interesting, useless fact. So I'm from Canada. I was in tourism. United States I was from Niagara Falls, was 60% of our tourist season. or 60% of our business. And every election year, our US business dropped 10 to, and for some really scary election years where there was a lot of fear mongering, it dropped more than like 30% just because people became uncomfortable, right? And even though Canada, you know, it's still an international destination at some point, and it was very interesting that, you know, you just had to know that.
The good thing is signs are there, right? If you look at Disney's wait time went down for the first time in the last 3 or 4 years or so. That means we're not buying high ticket items. If you look at the car prices, if you look at the dealerships, it was empty 6 months ago. Right now it's getting full, prices dropping. We're holding back. And that pressure has to be more and more and more. But either way, it takes time, right? If I have money in my pocket, I want to spend it. If I don't have money, still I got a big check. So my joke to all of my friends who got laid off from the Google, I was like, look, man, you got a year and a half, 2 years worth of vacation. They gave you a fat check and said, go find something else. Right? We lost a lot of jobs, but we lost a lot of jobs on the most expensive companies, and they have big fat checks. I know personally they got $1.5 million worth of check to get out from the Google. What they're gonna do, spend the money, right? So it's interesting times. That's all I can say.
Do you have the list of those people so we can start capital raising?
All right.
I mean,
They all do. I don't know. I mean, you know, go LinkedIn. That's it. You know, that's the best way to go.
I'll say Schreier told me that
Who?
have some money to spend, to invest, not spend.
It's I'm gonna go sideways. It's interesting. And there was one guy, he posted something from Google, whatever, and it went viral on LinkedIn. And he did another one. And then he said, okay, since I'm from Google, I do coding, I know a lot of people, and I met a lot of people that reached out to him. He's going to flip back and do startups. So I told him, hey, you know, I like to do angel investing. I've done a couple of them before from Rice. And so if you have something on the fintech or real estate, you know, or e-tech, let us know. Maybe Massive can help you go to the bridge. Next thing you see, you got 3 or 4 people reached out to us and trying to pitch a different product, interesting product, but it didn't work out.
And I just thought of something too, it's no education, but a lot of people ask about retirement funds. If you're in the Dallas market, Quest Trust is actually having an event next Tuesday night. And it's a very interesting event where you can meet vendor providers, people that have deals, people that have money. So I'll be there. Did it in Austin last night. But you know, there's a lot of events where you can connect with people.
Go to those events. I mean, it helps. Doesn't matter what you want to do. If you want to invest or if you want to do something, join this webinar. Once you get 10 webinars, you'll figure out who says what. And then once you follow those people, you'll know who we are most of the time. But you know, thing happens in between. But then, you know, I'll say just go join those. Those are very important. Right.
This has been awesome.
Yeah,
We're
this
going to
is
ask
good.
Mike
Thank you.
now. Mike's got to give us an interesting life fact because he's been quiet tonight. Something.
Hold on, before he goes, I still could not figure out Mike. And I've been working with Mike for, I feel like 5 years worth of time I spent with 1 year with him. He's an interesting dude.
So come on, Mike, tell us something we might not know about you.
Oh,
Mike,
something
yeah.
you don't know about me.
Well, I know several things about you, but the audience may not.
Let's see. I've been, I've met 2 presidents from 2 different countries. And I've been evacuated from 2 countries.
Because of war or not anything else. You gotta call it by
How many
that.
languages, Mike?
Probably 3.5.
On a bad day, right? And on a good day, 7.
Only when I'm in country, then it increases. So when I'm in country, it'll pop. I can go and pick up some stuff for the week or a few, you know, the time that we're there, and so the number increases at that point.
Awesome.
Mike, you were fluent. I
Mike,
mean,
I
you
remember
can
you
talk.
said, sorry.
Oh, sorry. Go ahead, Tracy.
Mike, I remember you stay in Singapore before for your job. Did you learn the Singlish?
Yes.
You said that
Yeah.
half the language you are talking.
What was that, Tracy? The last part?
Singlish. You said the half the language refer to the Singlish. You say you know 3.5 language. Which are the 3.5 language?
Oh, the 3.5. English, Portuguese, Spanish, and a mix between Indonesian and Malaysian.
Oh, Malay.
Malay, yeah, Bahasa Indonesia, Bahasa Malay.
I can speak Bahasa Malaysia.
Apa kabar?
Bye-bye.
Baik sekali.
Sama-sama.
I
can
barely
my
speak
chat
Nice to learn
GPT to
something
translate
new.
that.
I think
Mike,
they just
I
closed
said,
the
how are
deal.
you? I said, I'm good. So,
It's awesome.
Mike, can I share one little thing? I know you like funny socks. Interesting socks, right? You know, there's always something funny.
Socks or shoes?
Well, socks.
Socks and shoes, maybe.
Socks and
sometimes.
shoes.
Yeah.
Yes.
Because I don't like to go and it's hard for me to go meet people, so I wear a shoe or a sock that attracts attention to break the ice.
How many countries? 52 countries you traveled? Is that right?
75, 76.
God damn, man. Come on.
wow. It's a lot.
Wow.
That's good. That's awesome. I mean,
Yeah.
so I could say from my family perspective, we try to take the kids outside and try to hit 2 or 3 countries a year. And the way they grow by looking at the culture, the style, the lifestyle, it's amazing. And I could to say, I mean, if you guys know Mike Jr., I mean, he's a young kid with the adult mind in it. And that happened because he traveled, right? He sees differences in the whole thing. And so for everybody who doesn't want to leave your hometown, please leave. Go outside.
No, it's
that-
good to travel. I find that it's good to expand your horizon and you see different things, you learn the culture. Yeah.
So I grew up and spent my whole life from pretty much 0 till
Mhm.
18 in a town in a village in southern Illinois called Oblong. 1,200 people.
Which part of Europe you are born? I thought you are American, born in America.
It is American, yes.
Okay. You're born in America, is that right? Okay.
Yes.
Okay. So what does the 75 country tell you differently? Because you travel to 75 countries. What are those things we learn from this 75 country?
I believe probably just patience and respect is a lot of what I learned, honestly,
Mhm.
because of knowing that I didn't know a lot of times how to communicate for much of it,
Mhm.
potentially. And so just being respectful for others and
Mhm.
the patience to get things done, you
Mhm.
know, because I worked in many of them as well as traveled. So those would probably be the real life skills I learned from that.
Mhm.
Awesome. And I'm gonna share, and I'm gonna post my video. So I think I'm so interesting. I made a video about myself. Am I really the most interesting man in the world?
That's what most Canadians say, Trevor. I'll give you that.
Yeah. Did you know that instead of a swear jar, we have a sorry jar?
Yeah.
And
Awesome. Well, this has been
Hey.
an absolute
Well,
blast.
thanks.
thanks.
Thank you, everybody,
Thanks.
for coming. We will see you next week. Keep in touch, connect with anyone on the massive team if you have any questions or just want to get to know us.
Thanks,
Thank you,
everyone.
everybody.
Bye.
Great.
Have a good
Great.
night.
Good
Bye.
night.
Good night.
Bye.
Good night. Good night.